In today's rapidly shifting financial world, banks face this constant tension. How do they grow, stay competitive, but also remain stable, resilient?
Yeah, it's a real balancing act.
It really is. Like trying to run a marathon while, I don't know, building a fortress at the same time.
Hmm. That's a good way to put it.
So today, we're taking a deep dive into how leading global banks are navigating this exact challenge.
And we've got some great insights for this.
We do. They come from an in-depth study by Moodys based on conversations with, I think, over 30 senior execs across risk, finance, lending, all over the world.
That's right, a really broad perspective.
So our mission today is to, well, unpack the core pressures banks face, explore the innovative ways they're responding.
And figure out what really separates the leaders from the pack.
Exactly. So you can quickly grasp what's most important in this whole evolving landscape.
Okay, let's unpack this. So banks are definitely feeling the heat. We hear this phrase all the time, volatility is the new normal. But what does that really mean for banks? Beyond just general uncertainty, what are the specific pressures?
Yeah, it's more than just a buzzword. It's this constant state of unpredictability. Externally, you've got persistent market swings from geopolitical stuff, inflation, interest rates going up and down.
All over the place.
Completely.
Right.
And then layered on top, you have regulators getting much tougher, especially on capital allocation, how banks measure risk-weighted assets.
Right. The scrutiny is intensifying.
Massively. And internally, well, customer expectations are changing fast, and there's this relentless drive for efficiency. Do more with less. Always.
Okay, so how does all that pressure translate down to, say, borrowers and credit standards? It has a direct impact. Banks are getting much more rigorous in reevaluating borrowers. They're looking harder at resilience under stress scenarios, counterparty fundamentals, sensitivity to interest rate hikes.
So really kicking the tires more thoroughly.
Absolutely. And we're also seeing a big reassessment of legacy portfolios. Sectors like commercial real estate, healthcare, education areas that maybe seemed safer before. Now there are new concerns.
Interesting.
So the practical effect is this shift away from just lending volume towards fewer but deeper relationships with stronger, more resilient borrowers.
And I guess diversification is one response to that. We see banks, particularly in the U.S., moving into corporate lending, SME banking, asset-backed loans. Seems logical for capital relief, but is there a downside? Like venturing into areas they don't fully know?
You've hit it exactly. It is a fascinating dynamic. Diversification looks good on paper, right? Spread the risk, maybe give some capital relief. But there's this quote from a U.S. CFO in corporate banking that really nails it. Diversification is only good if you know what you're doing.
Oh, fair enough.
There's a very real capability risk. If you jump into a new lending area without the right expertise, the right systems, well, you might just be swapping one type of risk for another you're less equipped to handle.
I can see that. And it's not just market forces or internal capabilities, is it? The competition itself is changing incredibly fast. What's the deal with these new players?
Oh, it's a whole different ballgame now. Non-bank lenders are surging. You've got these powerful private credit firms, especially in the U.S., who can act really decisively, take on higher risk deals banks might avoid because of regulation.
Right, they have more freedom.
Exactly. Then you have alternative lenders, fintechs, debt funds, particularly big in APAC for consumer and small business loans. They offer instant decisions sometimes.
Wow.
And then specialized lenders who know niche sectors inside out. They're incredibly agile.
Well, what's their edge? Speed, simplicity.
All of the above. They're agile, often less regulated, definitely faster, and their products are usually more streamlined. A chief risk officer in APAC put it bluntly. Fintechs are a winning share because they're simply faster and easier to deal with. They're built around digital convenience.
So how are the traditional banks fighting back?
Well, they're trying various things, providing back leverage to some of these players, forming partnerships. Some are even launching their own internal debt funds. But mostly, they're being forced to seriously rethink their own speed and service levels.
Which leads us right into this core idea of resilience. The study suggests it's not just about, weathering storms. It's more fundamental. Changing how risk itself is approached. What does that mean in practice? And what's stopping banks from doing it?
You're right. It's a really profound shift needed. The study found three main barriers. First is this lack of a genuinely holistic view of risk. Meaning banks often still look at risk in silos. Credit risk over here, liquidity risk there, cyber, reputational, regulatory, all separate buckets.
They're all connected, surely.
Deeply interconnected. But the structures often don't reflect that. A European chief risk officer said, credit risk still dominates day to day, but increasingly we're having to pay attention to less familiar exposures, cybersecurity incidents, liquidity stress, reputational risks, and regulatory changes. Bringing those together is key, but hard.
Right, getting everyone looking at the same picture. Someone in the report used that analogy about everyone looking at an elephant from a different angle.
Exactly. That quote came from a U.S. managing director in finance. Right now, there's no one dashboard. Everyone's looking at the elephant from a different angle. And that points straight to the second barrier, workflow fragmentation.
So disconnected processes, different teams doing their own thing.
Precisely. Different teams using different models, sometimes even speaking different risk languages, using totally disconnected systems.
Is that just a tech problem? Or is it cultural too? Resistance to sharing.
It's often a mix. The tech might be disjointed, but yeah, sometimes there's a lack of institutional push or incentive to break down those walls. And the costs are huge. Delays in approving credit, missed early warning signs, difficulty steering the portfolio effectively. It's a major coordination breakdown.
Okay, so lack of a holistic view, fragmentation. What's the third barrier?
It's the limited real-time visibility and, crucially, early warnings. Too many banks still rely on lagging indicators. They react after the problem's already grown.
So they need to see things coming before they hit.
Exactly. Dynamic risk insight, early warning signals. There are efforts underway, building internal dashboards, tools to track borrower performance against covenants, market sentiment, applying macroeconomic stress overlays.
And trying to bridge the gap between, say, risk teams and the front line.
Yes, things like creating integrated deal teams, actually embedding risk professionals within the business units, investing in shared dashboards, shared data lakes, anything to get that common operating picture.
So, okay, building resilience is one thing, but banks also have to compete, right? Be faster, smarter.
Yeah.
Where are the big operational struggles there? What slows them down?
Yeah, the research really highlighted 4 consistent challenges here that act as barriers. First one, just plain old speed of decision making.
Things getting stuck.
Yeah. Deals stall? Why?
Mm-hmm.
Unclear ownership, like who actually has the ball, lack of visibility on where things are, and that workflow fragmentation we talked about. It means manual handoffs, people rekeying information. It's slow and inefficient.
There was a great quote about that. It's something about racing tires.
Ah, yeah, the head of wholesale lending in the EU. It's like putting racing tires on a broken down car. You can have the best tech, but if approvals still run through 3 teams in a spreadsheet, it doesn't matter. Really sums it up.
Okay, so speed is one. What else?
Second challenge, consistently profitable pricing. It's hard to bake real-time risk and capital costs into pricing models when you've got those manual workflows and disconnected systems. So there's a lag, market changes, but pricing doesn't keep up quickly enough.
Making it hard to be both competitive and profitable.
Exactly. Third is portfolio optimization. It often lags way behind. Many banks are still using backward-looking tools, often Excel-based, to track risks and concentrations at the portfolio level.
So they're missing opportunities to adjust proactively.
Pretty much. A chief revenue officer in the U.S. was quite candid. Optimizing portfolios with AI is something we talk about, but we still run most scenarios in Excel. That really limits their ability to steer the ship in real time.
And the fourth challenge.
Smoother onboarding and servicing. This is still a huge drag on productivity and, importantly, the client experience, especially when you compare it to the slick fintechs.
Right.
Things like credit data or early risk inputs often just arrive too late in the deal cycle. A head of wholesale credit risk in Europe said, onboarding is still a mess. KYC is digital now, but credit data often arrives late, slowing the whole process down. It's a big source of friction.
Listening to all this, it sounds like technology should be the answer. But the report suggests it's not that simple. Why isn't more tech fixing these problems?
Yeah. You're right. It's not a silver bullet. The problem isn't usually a lack of technology. Most banks have tons of tools.
So what's the issue?
The issue is they're disconnected. Data's stuck in silos, workflows are fragmented across different systems, collaboration is difficult. There was this quote from a U.S. commercial lending officer.
Let me guess. Something about Excel.
You got it. He said, we've got systems for everything. Our problem is they don't talk to each other or to us. So people go offline. Excel still runs the business more than it should.
Ouch. So it's the integration that's missing.
Precisely. And that's where the investment focus is shifting now. Towards tech that brings alignment, integrated dashboards, workflow engines that span different teams, early warning tools, platforms that connect credit risk assessment with finance and origination.
The tools only work if the underlying platforms are actually connected, right?
Absolutely. You can't just slap a new dashboard on top of broken processes or disconnected data. You have to fix the foundations. Integration is key.
Okay, and looking ahead, AI, advanced analytics, everyone's talking about it, but it sounds like there's a bit of a chicken and egg situation. Banks need good data for AI, but maybe need AI to help clean the data. How are the leaders tackling this? What's the main hurdle?
That's a perfect way to describe it. Banks are exploring AI, piloting things for speed, efficiency, faster credit scoring, quicker insights, earlier risk detection.
That's promising.
It is, but the biggest barrier consistently is trust and transparency. Especially for core decisions like credit. Teams are hesitant to rely on an AI model if they can't fully understand why it made a certain recommendation.
The black box problem.
Exactly. A director of credit risk in the U.S. shared their experience. We're piloting an AI-driven scoring model. The issue wasn't accuracy, it was explainability. If something goes wrong, who's accountable? That's a huge question.
So explainability is key. What are the other main challenges holding back AI adoption?
The report flags 4 main ones. First, that siloed, inconsistent data we keep mentioning. Second, low trust without clear governance around the AI. Third, legacy infrastructure just makes integration really hard. And fourth, good old internal resistance to change. People stick to what they know.
So what's the way forward? How do banks close that gap?
Well, the hope lies in building cleaner, connected data infrastructures that's foundational, then focusing on glass box AI models, the ones that are explainable.
Right, where you can see the workings.
Yeah. Also, putting in place integrated governance frameworks for AI and really embedding the technology deeply across functions so it becomes part of the normal workflow, not some separate AI project.
This all paints a pretty challenging picture, but the report also talks about the pioneers, the banks that are getting this right. What makes them different? How have they transformed their approach?
Yeah, this is where it gets really interesting. The research basically saw 3 groups. Traditional banks, still fragmented, kind of slow. Mainstream, aware of the issues, trying things, but inconsistent. And then the pioneers, they're setting the pace. They're actually using risk to grow smarter.
Okay, so what defines these pioneers? What are they doing differently?
Several things stand out. First, they have that truly holistic view of risk we talked about. They integrate everything, credit, market, liquidity, regulatory, into unified models.
Not just silos.
No silos. Second, they've built sophisticated early warning systems. They're forward-looking, anticipating issues, not just reacting. Third, they've internalized regulation, using it strategically to sharpen decisions, not just as a compliance burden.
Interesting twist.
Fourth, real-time stress testing isn't an annual chore. It's embedded in day-to-day strategy, informing live decisions. And maybe most importantly, risk is truly embedded early in the process, right from the start of structuring a deal.
So it sounds like risk moves from being, well, a roadblock maybe, to more of a partner in the business.
Exactly. That's the fundamental shift. From policing to partnership. Risk isn't just the no department anymore. It's a strategic partner. Risk teams get involved much earlier, helping shape good deals, figuring out solutions, not just flagging problems late in the game. And importantly, the frontline teams also start thinking with a risk lens from the very beginning.
As that US CFO said.
Yeah. Risk isn't there to say no, it's there to make sure we say yes for the right reasons. That mindset changes everything.
Do we have examples of this in action?
Absolutely. The report highlights a few leaders. There's Francis, a senior finance exec at a U.S. regional bank. His team uses holistic capital stress testing, integrating interest rate, liquidity, and credit scenarios together. It gives them a unified, realistic view of capital vulnerability. It's not just ticking a regulatory box. It actively informs smarter capital allocation.
Makes sense. Who else?
Then there's Felicity, a risk leader at a UK bank. Her team gets brought into deal structuring really early. It builds a strong culture of partnership and trust with the front line.
So they're shaping deals together.
Precisely. Her quote was great. "We don't want to be the people who stop deals. We want to be the ones who shape them properly." That proactive approach means cleaner deals, fewer last-minute delays.
Nice. And one more.
Amy, a lending leader in Europe. She really sees risk as a lever for doing smarter business. Her team pre-screens deals aggressively, apparently discarding over 90% before they even hit formal credit review.
90%.
Yeah, but it's not about being overly cautious. It's about focusing resources on deals that are genuinely credible and commercially sound. She takes that holistic client view, uses risk appetite as a shared language. It helps them price better, respond faster, deepen relationships, all without taking on undue risk.
Here's where it gets really interesting.
Mm,
These pioneers show it's possible.
it absolutely is. They show that risk management can be a competitive advantage, not just a cost center.
Okay, so we've covered the pressures, the challenges, the barriers, and now what the leaders, the pioneers, are doing. Let's bring it all together. What are the key strategic takeaways for banks aiming for this balance of growth and resilience? What's the path forward?
Based on everything we've discussed, the study points to 4 clear strategic priorities. First, invest in integration, not just innovation.
Connect the dots you already have.
Exactly. It's less about buying the next shiny tool and more about making existing platforms across credit, finance, origination actually talk to each other. Create that unified picture of risk, deal progress, capital impact.
Okay, priority 1, integration. What's 2?
Second, embed risk early and often. Move from being reactive to proactive. Use those early warning systems, do proper scenario planning, monitor things in real time, surface the risks before they become deal blockers.
Get ahead of the curve. Makes sense.
Uh,
Third,
Third, shift the risk mindset from policing to partnership. We talked about this. Risk shouldn't be slowing things down unnecessarily. It should be helping the frontline structure smarter deals, filter out the bad ones early, inform capital allocation, and get the pricing right from the beginning.
using risk constructively.
Precisely. And finally, number 4, make resilience a shared responsibility.
Break down those silos for real.
Yes. It can't just be the risk department's job. It has to be embedded in how everyone operates daily. Foster shared accountability across risk, finance, the business units. Technology should help here, making sure data flows freely, platforms speak the same language. Resilience becomes part of the organizational fabric.
So it's about culture and process enabled by integrated tech.
That's a great summary. Evaluate exposure together, stress test scenarios together, pivot portfolios together in real time.
So what does this all mean?
Well, I think the ultimate goal here is building this culture of, let's call it confident, connected growth, where resilience and competitiveness aren't trade-offs, they actually reinforce each other.
Enabling smarter growth, not just faster growth.
Exactly, letting banks act with more precision, more clarity, more control, growing smarter and ultimately safer.
What a fascinating deep dive. It's clear the future isn't about choosing growth or stability, but really weaving them together seamlessly. That integration piece seems absolutely crucial.
Mm-hmm.
It makes you think, doesn't it? Considering how interconnected all these banking functions are, how could this kind of silo-busting approach apply maybe to challenges in your own field or your own organization? Where could greater integration and shared responsibility make a difference? Something to mull over.
Definitely food for thought.
Well, thank you for joining us on this deep dive into smarter banking under pressure.
My pleasure.